Hello everybody, my name is Guilherme and I will talk about three questions. What is finance? What is finance management? And what is corporate finance? Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. There are three types of finance: personal, corporate, public, and government. Now, I would like to illustrate this concept.
What is finance? Back to basics, huh? Okay, time me 1 minute. Businesses generally need money or capital to start, to grow, to diversify. The money that people save or invest can be used to finance businesses. Put simply, finance is connecting people with surplus money to people with ideas. But you don't just walk into Tata and give them your nest egg. Similarly, the Amul girl doesn't just come knocking on your door asking for cash. No, you need to go through an intermediary, someone in the financial services industry. An advisor can help you save or invest through a range of financial institutions like banks, insurance companies, mutual funds, alternative funds, and non-banking financial institutions. Firms that help businesses raise the capital are called investment and merchant banks. And the place this exchange happens is called the market.
Finance management is concerned with the support and creation of the economic value are healthy. Consequently, focus on decision making with an eye toward clear healthy. As such, we deal with finance decisions such when to introduce a new product, when to invest in new assets, when to replace existing assets, when to borrow from banks, when to issue stocks or bonds, when to extend credit to a customer, and how much cash to maintain. Corporate finance deals with the capital structure of a corporation, including its following the actions that management takes to increase the value of the company. Corporate finance also includes the tools and analyzers used to prepare and distribute finance resources. We have three perspectives that govern corporate finance. First, investments and capital budgets. Second, capital finance. And last, dividends and return of capital. First, investments and capital budgets includes planning when to replace the company's long-term capital assets in order to generate the highest risk-adjusted returns. Second, capital finance. This core activities includes decision on how to optimally finance the capital investments through the business equity, debt, or mix of both. Long-term funding for major capital expenditures on investment may be obtained from selling company stocks or issuing the debt securities in the market towards investment bank. And last, dividends and return of capital. These activities require corporate management to decide whether to return the business excess range for future investments and operational requirements or to distribute the earnings to shareholders in the form of dividends or share buybacks. So, in this last video, I would like to summarize everything I said. What's the goal of finance management, which is to maximize the value of the firm and stakeholders.
Hi guys, my name is Aline and today I will explain you the 10 principles of financial management. The first one is the risk-return trade-off. Uh, the basic of this principle is we won't take on additional risk unless we expect it to be compensated with additional return. That means if you put some value in a stock, you expect to receive some value, some profit back. So when you invest in stocks with less risk, you will receive, we will be compensated with less return. But if you invest in a stock with a big risk, you expect to be compensated by a big return. Okay? So the second one is the time value of the money. That means a dollar received today is worth more than a dollar received in the future. Why this happens? Because if you receive $10 today, you can buy, for example, 10 brigadeiros, and in the future, because of the inflation, probably the brigadeiro will be cost $1.10. So we can't buy 10 brigadeiros in the future. So because of the inflation, $1 today is more value than $1 in the future. The third principle is the cash, not the profit, is the king. That means the cash is the most important, the cash flow is the most important, not the profit, because the cash helps us to measure the health of our organization. And when you have the profit isn't reinvested in the organization. The cash is. The profit, we understand the profit we take of the organization for yourself, and the cash you reinvest in the organization. So the cash is important to make sure the organization health is not the profit. Because of this, the cash is the king, the most important. The fourth principle is about incremental cash flow. That means it's only what changes that counts. This principle helps us, the cash flow helps us to understand what a decision made in the past did at the present, do at the present. So for example, we decided to buy a new machine, and the machine it's working, and when you see that the cash flow it is best, that it is incremental cash flow, we can say it was a good decision. Or if it was lose in the cash flow, we can say it's not a good decision. So the incremental cash flow help us to understand if a decision did in the past was a good decision or not. The fifth principle, it is about the curse of competitive marks. And the question is, why it's hard to find exceptionally profitable projects? Well, if you invest in some stocks, you can see that it's hard to find something that can be exceptional value in the future, like 18% for a year or something like that, because of the course of the markets. The markets are all the time looking for a balance. So if some stocks like Magazine Luiza costs $5, well, a lot of people buy, and the price increase. But when the price increased, the investors started to sell them, so the price go down. So because of this balance, it is hard to find a stock or investment that will be so much profit. The sixth principle, it is about efficient capital markets, and it means the markets are quick and the prices are right. So if you buy a stock in this moment, if the price it's was now is now, it was the perfect market. You can think like, oh, but if I had to buy in the past, or if I had to wait some time more and buy in the future. No, the price is right and the the things are right in the moment you buy the stock. It is the efficiency of capital markets. The seventh principle is about the adjacent problems. What it means? We have two kind of people here. We have the organization and ownership, like Steve Jobs. He was the owner of Apple, and we have the agents, like the CEO, the board directors, and other people that represents the organization. So sometimes the interest of these two person don't agree. So we have a conflict between these two person, and so we have a problem because sometimes the CEO says, if you buy this machine, it's best for our company, but the ownership don't want to spend more money. He wants his profit. So it is a conflict between interests for these two kind of people. The eighth principle, it is about the taxes-based business decision. So it is like you can't make a decision without consider the taxes. So the taxes are an important thing to make a decision in the organization, in the financial and in the investments. So the next principle, it is about all risk is not equal. That means some risks can be diversified and some cannot. We can see like we have different segments in about stocks. We have transportation stocks, we have retail stocks, gas, petroleum, we have energy stocks, have a lot of kind of segments in stocks. And we can buy different stocks for each segment, or we can buy stocks about only segment. But if I have a problem with transportation and I only have transportation stocks, probably all my investments going down. But if I have a little of stocks in transportation, a little in energy, a little at the retail, so I have my stocks will going down, but not so much because it's only transportation problem, and so only transportation stocks will going down. But this is a case of the risk can be diversified, but we have cases like coronavirus. This pandemic affected all the market. So transportation, energy, retail, all the stocks gone down because of the coronavirus. this pandemic affect all the market. So we have a diversified stocks, but this problem affect all them. So the last principle, the tense, it is about ethical behavior, and ethical behavior means do the right thing, but ethical dilemmas are everywhere in finance. For example, when someone has uh, a precious information about something, and oh, this organization uh, will do something that will increase his profit, and I know that information before of the other people, so I can buy their stocks, uh, because I know in the future that will be more available. But it's not ethical because I have an information, a previous information that no one has. So is it ethical? So it's important to think about ethical dilemmas, because if I have an organization and I buy a lot of stock of this organization because I know in the future we do something to probably will increase our profit, so our cash flow. So it is not ethical. I buy a lot of stocks to win a lot of money, so to earn a lot of money. So it is about ethical. So it's important to think in finance too.
First, remember that I adopt the rules of the Brazilian financial market, that is B3. There are some different rules between the Brazilian and the American. Well, there are topics to cover: stock concept, initial public offering, primary market, secondary market, preferred stocks, common stocks, other concepts, best known stocks. And have you heard of stocks? Have you invested in anything? Do you want to work in the financial market? It's necessary to know some key concepts that I will present to you. The shares are small fractions of a company's share capital, such as Petrobras, Vale, and Banco Itaú. Therefore, when you are investing in Vale's shares, for example, you acquire a part of the company. But be careful there. It's very important that you invest in shares of companies that you match with you. You follow your principles. You are buying a part of the company. Thus, it's essential to know about the company's management, its main strategies, and its situation in the financial market. For example, you don't want to invest in a corrupt company, right? In this way, I would like to highlight 3 things you should know before investing in stocks. First, believe in the business. Second, look at the market in which it's inserted. Give an example of a declining market, automobile example in times of COVID-19. And seek to know that technical analysis of the quotation. Attention! If you are a professional who wants to follow this branch, it's necessary that you know how to do this analysis. If not, don't worry, okay? You may be asking yourself, why do companies issue shares? For companies, issuing stocks is a way to raise money to grow and invest in their business. For investors, stocks are a way to grow their money and outpace inflation over time. The investors usually buy more expensive shares to sell in the future. However, there are other types like short sales. And how does it works? It all starts with the IPO, initial public offering, where the company is listed on the stock exchange. The main objective is to raise funds cheaper and more abundantly than a bank loan. Thus, people interested in the development of the company negotiation these rules in the orders to assist in their development and profit from the sale. And with the purchase of these assets, you become a shareholder and partner of the issuing company. For example, you can be a partner of Petrobras, Banco do Brasil, or Magazine Luiza. Now, I want to explain more about the two types of existing markets, primary and secondary market. The primary market is where securities are created. It's in this market that firms sell new stocks and bonds to the public for the first time. In the secondary market, investors trade previously issued securities without the issuing company's involvement. Therefore, investors trade among themselves. And there are some types of stocks, common stocks and preferred stocks. Common stocks is one where the investor has the right to vote and participate in the management of the company. The greater the volume of shares, the greater the right to participate. Preferred stocks are those that don't give the right to vote, but normally pay fixed dividends so that the owners can count on a defined amount of income from the stock each year. In order to help you invest in the stock exchange and understand how it works, I will briefly bring you the main concepts and rules of operation. In Brazil, we have our stocks exchange B3, in which its main index in the Ibovespa, formed by the most traded shares, until completing 80% of the average volume. This usually amounts to just over 60 companies. Here, I brought you some of the best known stocks, such as Magalu, Itaú, and Vale. They are among the 50 largest companies in the financial market, and they are very interesting.
Hi guys, bem que Nath. As Natalia said, I will tell you about bonds. What are they? What's the difference and similarity of the stocks? Shall we begin to understand? Just as you can open a saving account at the bank and earn interest on your saving. So, can you buy a bonds? Bonds are an asset class where the investor borrowed money of the government or other company for a set period of the time with the promise of repayment of that money plus interest. The income of bonds are fixed in each period into maturity or yield to maturity. Bonds have 5 important relations. The first, the value of the current interest rate is inversely related to change in the investor present required rate of return. Are you confused? Stay relaxed. I will explain you of the other manner. The relation say that if the interest rate decrease, bonds will increase. And the opposite is true. Second, for this relation, I will present you an expression. Yes, expression.
If he carried weight the greater than coupon rate, then market value is less than par value. If he carried weight equals to coupon rate, then market value equals to par value. If he carried weight then less than coupon rate, then market value is greater to par value. In this case, we have a premium bond, a bond that is selling above its par value.
Stop. We'll go understand what is the meaning of these words. He carried rate is a required rate of return. Outweighs the risk of a security investment. Coupon rate is a fixed return that an investor earns periodically into the materials. Market value is the observed value for the assets in the marketplace. Par value is the face value or future value that is returned to the bondholder at the maturity. Maturity indicates the length of time into the bond issuer, the par value to the bondholder, and terminates or redeems the bonds. 30. As the maturity dates approach, the market value of a bond approaches its par value. I think it's clear this definition, isn't it? If you're reading the money to maturity, your money will be their par value. So, the money will be equals to market value. For long-term securities have a higher interest rate risk than short-term securities. That's because if you have more time, the greater the uncertainty of your payment. Fifth, the sensitivity of a bond's value's interest rate depends not only on the length of time to maturity, but also on the pattern of cash flows provided by the bond. Consider 2 bonds, A and B, both 10 years to the maturities. Bond A pays $100 interest annually, with the $1,000 principal being repaid at the end of the 10th year. These cash flows are received in the more distant future on average than are the cash flows bonds A, because a change in interest rates always has a greater on the present value of cash flows than on early cash flows, due to the effect of compounding. Bonds with cash flows coming later, on average, will be more sensitive to interest rate changes than will bonds with early cash flows. But what are the types of bonds? Well, I will mention 6 types that we have. The first, the debentures. Second, subordinate debentures. 30, mortgage bonds. 4, euro bonds. 5th, zero and very low coupon bonds. And 6, junk bonds. Now, we will understand each of these types of bonds. The first, debentures. Debentures are unsecured long-term debt. Because this bond is unsecured, the inability of the issuing corporation is of great concern to the bondholder Today's firm, the major advantage of debentures is that no property has to be secret by them. Second, subordinate debentures. A debenture that is subordinate to other debentures in being paid in the case of insolvency. The clients of the subordinate debentures is the clients of the honorary the subordinate debentures are honored only after the clients of secured and unsubordinate debentures have been satisfied. 30. Mortgage bonds. A bond secured by a lien on real property. Typically, the value of the real property is greater than that of the mortgage bond issued. This provides the mortgage bondholders with a margin of safety in the event the market value of the secured property declines. 40. Euro bonds. They are simple securities. In this case, bonds issued in a country different from the one whose currency the bond is denominated. For example, a bond that is issued in Europe or Asia by American company. If the payment interest and principal in dollars, will be considered an euro bonds. Fifth, zero and very low coupon bonds. Along the ways of firm issue bonds. They issue firms to issue bonds at a substantial discount from their $1,000 face value with a zero or very low coupon rate. The investor receives a large part, or all, with the zero coupon bond, of the return from the appreciation of the bond. Bonds issued at a substantial discount for their $1,000 face value that paid no or little interest. Sixth, junk bonds are high risk debt with rates BB or below by Moody's and Standard & Poor's. The lower the range, the higher the chance of default. The lowest class is CC for Standard & Poor and CR for Moody's. Originally, the term was used to describe the bonds issued by fallen angels, that is, firms with sound financial histories that were faced several financial problems and suffered from poor credit rates. They are so called the high yield bonds for the high interest rates they pay the investor. Typically have an interest of between 3 and 5% more than AAA rate long-term debt. Hey, stop! What are rating Standard and Poor's? Poor and Moody issued the first rating in 1916, followed in 1922 by the Standard Statistics Company. The rating symbol is represented in a group whose characteristics are similar. John Nolan Fitz also studies the same subject and founded the Agence Fitz. He further developed the subject and consolidated the symbols that are used into today. An asset rating addresses the risk involved with the performance of a particular asset. It assesses the issuer's ability to comply with the terms determined by the security, and combining the risk of default and a given expectation of loss in case of default. There is the risk of the asset. The rating scales ranges from AAA to D. AAA being the high-class rating assigned to issuers or bonds that have the lowest expectation of default risk in relation to all other issues in the same country. The D denotes that an issuer our debt instrument is in default. The rates from AA to CCC may be modified by the additional a plus or minus sign to slow relative standing within major rating categories. You understood about stocks and bonds, right? But you must be wondering, and what money I will save from this? What is the meaning of the money I will earn, and what is the process like? How to save money to be able to make applications? Very calm that I will start this explanation and let Bruno and Ian talk to you in more detail, okay? The value of a bond is the present value both of a future interest to be received and the per or maturity value of the bonds. The process for evaluating a bond requires knowing three essential elements. First, the amount and the time of the cash flows to be received by the investor. Second, the time of the maturity of the loan. And third, the investor carried rate of return. The amount of cash flows is dictated by the periodical interest to be received and by the per value to be paid at the maturity. Periodically, each investor could have a different required rate of return for a particular security. To measure the bondholder expected rate of return or yield to maturity, the discount rate that equals the present value with the future cash flows. Interest and maturity value with the current market price of the bond is the rate of return of the investor will earn if a bond is held to maturity. We would find the discount rate that equates the price value of the future cash flows with the current market price of the bonds. Okay, I hope you understand what I explained you. Keeping watching more video for you understanding how you get save money to start your investment.
Hello guys, I'm Bruno. I am business administration student. Today I'm going to talk about what is the cash flow and what is the difference of between cash flow and net income. Okay, so first I will talk a little about what is the cash flow. It is a fundamental tool for the management of any business. Moreover, it is very important to know the viability of the company, because one of the ways to measure whether the company if it grow and the company if it is growing or not is by assessing its cash flow, as it controls financial transactions, inflows such as sale of fixed assets, money received by customers, and investment gains. The cash outflows, on the other hand, can originate with the purchase of inventory, payments of the employees, payments of interest, purchase of the fixed assets, payments of suppliers. When a company has positive cash flow, it allows the company to be able to reinvest in the company, make new investments, and pay the future debits. In addition, it is possible to analyze cash flow in three different main ways. So the first one is operating cash flow. Includes all cash generated by a company's main business activities. The operation cash flow is a measure of the amount of the cash generated by a company's normal business operations. The operation cash flow indicates whether a company can generate sufficient positive cash flow to maintain and grow its operations, otherwise it may require external financing for capital expansion. And the second is the investing cash flow. Okay, the investing cash flow includes all purchases of capital assets and investments in other business ventures. The cash flow from investing activities is one of the sections on the cash flow statement that reports how much cash has been generated or spent from various investments related and the activities in a specific period. Investing activities include purchase of the physical assets, investments in securities, or the sale or the securities or assets. The last one is the financing cash flow. The financing cash flow includes all proceeds gained from issuing debt and equity, as well as payments made by the company. The cash flow from financing activities is a section of the company's cash flow statement, which shows the net flows of cash that are used to fund of the company. The financing activities include transactions involving debits, equity, and dividends. The cash flow from financing activities provides investors with insight into a company, financial strength, and how well a company's capital structure is managed. Now I'm going to talk about another indicator. It is a free cash flow. The free cash flow represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Unlike earnings or net income, the free cash flow is a measure of profitability that excludes the non-cash expenses of the income statement. Includes spending on equipment and assets, as well as changing in working capital from the balance sheet. Now I will explain what the difference between the cash flow and the net income. So First, I will going to talk what is the net income. The net income is calculated by subtracting the cost of the sales, operational expenses, depreciation, interest, amortization, and taxes from total revenue. Uh, Also carried accounting profit. Net income is included in the income statement along with all revenues and expenses. So the net income is the profit a company has earned for a period, while the cash flow from operating activities measures in part the cash going in and out during a company day-to-day operations. Uh, the net income is the starting point is calculation cash flow from operating activities. However, both are important in determining the financial health of a company. Still, the net income is the bottom line profit that a company makes, and even if a company has positive operation cash flow, can still lose money when all is said and done. Now I am going to show you a short video to better explain the concepts of the cash flow in practice.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies. Ed makes his living running Ed's Carpets. For Ed, cash flow is essential to the survival of his business as well as his personal finances. Having ample cash on hand ensures that Ed can pay his employees, his creditors, and himself on time, keeping the business afloat. The same goes for Ed. He needs enough cash in his personal bank account to pay for his house, his car, and other personal expenses. Whether we are talking about Ed or his business, there are generally three types of cash flows. 1. Operational cash flows refer to cash received or spent as a result of a company's business activities. For example, a business like Ed's Carpets brings in cash by selling carpets and sends cash out to pay employees and suppliers. Similarly, Ed pays himself a salary, providing cash flow to his personal account. Cash will flow out to pay for his expenses such as food and housing. 2. Investment cash flows refer to cash received or spent through investing activities, basically the purchasing and selling of assets that will help grow the business, or in the case of Ed, assets that will help increase his net worth. 3. Financing cash flows refer to cash received through debt or paid out as debt repayments. For a company, issuing stock, paying down debt, and repurchasing shares would count as part of financing cash flows. For Ed, financing cash flows include any cash coming from loans or other types of debt, as well as payments going to pay down debts. If Ed's business comes up short on cash and is unable to pay its obligations, it will experience a cash flow crunch. To avoid insolvency, Ed will have to arrange some type of financing or bridge loan. A similar situation in Ed's personal accounts would also have disastrous effects that could lead to personal bankruptcy if the cash flow crunch persisted. For this reason, it is important that businesses and individuals manage their cash flow carefully and set aside emergency reserves to cushion any unexpected events.
Hi everyone, my name is Ian Araújo. I'm studying Business Administration at Unifei, Itajubá. And today I'm going to talk to you about some financial terms. They are: what is a budget, what is a forecasting, the difference between budget and forecasting, and the difference between credit and debt. Well, the first term that we're gonna talking about is a budget. Budget or to budget, it can be a noun or a verb, means to make a plan on how to spend a certain amount of money. So, for example, government has this much money they need to spend, or they have a plan that they want to spend this much money. So, let's suppose that they want to spend $1 million. I've been very simple here. I'm getting short numbers. It's only to give us an example. So they need to spend $1 million to provide all service that they need to buy all materials that they need to import, etc. Now let's understand what is a forecasting. We have to be careful to not confuse forecast and budget. Forecasting is determining what is going to happen in the future by analyzing what happened in the past. It's a planning tool that help business people to attempt to cope with their uncertainty of what will happen or not. Forecasting relies on past and current data and analysis of trends. So, company managements, government departments, economists, and investors utilizing forecasting to decide how to allocate their resources and prepare reports. They also use it to plan and anticipate expense. Now let's talk about the difference between budget and forecasting. As I said before, sometimes we can confuse these two terms. So let's go. The main difference between them is that budget lays out the plan for what business wants to achieve, while forecast states is actual expectations for results, usually in a much more summarized format. Forecasting is a projection of what is going to happen at much more higher level and includes revenue items, overall expense, and another business components. A budget estimates how much revenue and expense a business may incur over a future period. And the forecast, on the other hand, estimates the business financial outcomes by generating and analyzing historical data. Well, now we're gonna talk about the difference between credit and debt. The credit is the ability to borrow money. For example, if you want to buy a car or a house, you can buy because the bank give you money, and after you pay for that. In other words, the bank give you the money and then you slowly pay them back. Now, if the bank give you $10,000 to buy a car, now you're gonna have $10,000 debt. Notice that I don't pronounce the letter B. You usually say debt, not debit. Okay? That means owing. You owe money to someone, usually the bank. And to complete this concept, let's talk about credit rating. Credit rating means how much or how little banks will give you. In other words, basically tells you how much you can borrow. If you had a bad credit rating, means that nobody's give you any money.
So now we're gonna talk about some indicators. The first indicator is rate of return, the famous ROR, and it is the net gain or loss of an investment over a specific time period. So normally in the end of the year we see this indicator. We use this indicator to see how much profitable our organization is or is not, depend of the situation. The second rate is the rate of return, internal rate of return. That is a metric used in a capital budget, or that means when we gonna do a budget, we use the internal rate of return to estimate the profitable or potential of investments in our organization. So now we're gonna answer the question, how to evaluate a project. When do you go to invest your money in some project? We have to be certain that this project is profitable. So we have three metrics to use to evaluate a project. So there are net present value, NPV, the internal rate of return that we saw before, and the payback period. So we will talking about these three metrics to evaluate a project. The first is the payback period. It is about how much time will take to this project be paid for itself. So obviously does not consider inflation, depreciation, maintenance costs, project lifetime, and other factors. But with payback, you can see how much time I will take to start to receive my investment back. So, for example, I will build a cinema. So I have to invest, I don't know, $20 million. So how much time I have to wait to start to receive the profit of this investment? Because if you think the first month, the second, the third, how much time I have to wait to have my initial investment back and start to receive to earn money from this investment. This is the payback period. After that, we have NPV, net present value. That is the difference between the present value and of the cash inflows and the present value of the cash outflows over a period of time. This indicator is interesting because it considers inflation rate during the period. So with NPV, it's the dollar amount difference between the present value of discounted cash inflows less outflows over a specific period of time. So if the indicator is positive, the company is the project is able to give a result, a positive result for the company, be profitable. So NPV is one way to evaluate a project. So the last one is the international rate of return, IRR, that we will talk before. So this is calculation uses the estimate of the profitability of the potential investment. So this indicator can estimate the profitability of potential investment using a percentage of value greater than $1 a month.